Hi students, this is S. Kumar. So today's concept is financial break-even point. So look at the example. Saket Limited has three financing plans to finance the investment. So what is the financial break-even point? What is the financial break-even point? Then, so the company requires 20 lakhs towards investment. This amount can be raised from three options. We call it as financing plans. Plan A, Plan B, Plan C. In Plan A, the total amount will be raised by issuing equity shares. There is no preference and debentures. In Plan B, 50% comes from the equity and the balance 50% comes from the debt. We call it as debentures. Debentures, bank loans are called as debt. Plan C, this is combined with equity, preference and debentures. So then, in any option, what is the total amount here? 20 lakhs. So the company wants to know the financial break-even point. First of all, equity, preference and debentures are long-term resources. Equity is called as own capital or owner's capital. Preference and debentures are called as external sources. Interest on debentures and dividend on preference shares put together called as fixed financial obligations. So dividend on preference shares is a fixed financial obligation because if the nature of the preference shares is not mentioned, we take it as cumulative. In such a case, if the dividend payment is not done in any year, that should be carried forward to the subsequent years. That should be paid out of the profit. Hence, we are taking debentures and preference shares at par. Therefore, interest on debentures, dividend on preference shares should be taken in line. Accordingly, the company has to appropriate sufficient profit towards the payment of these two obligations. Then, tell me, financial break-even point. So, whatever profit comes from the project, that must be paid to all these finances. But there is a change in the priority. First priority goes to debenture holders. So out of the profit earned from the project, interest payment is done. Thereafter, the second priority goes to preference dividend. Then any surplus profit is there. We call it as residual profit that goes to equity shareholders. So equity shareholders are benefited from the project only when they have a residual profit from the project. Then only the EPS of the company will be positive. I hope you got it. Then look at this. When you are funding from the Plan A, we don't have any fixed financial obligations. Since debentures, when we don't have any debentures, preference share cap issue here. Plan B, 10% debentures, how much it is? 10 lakhs. 10 lakhs into 10%, you should pay an interest of 1 lakh to pay. Similarly, in Plan C, an interest of 50,000 has to be paid on preference shares. 50,000 into, this is not 12%, 10%. 5 lakhs into 10%, 50,000 preference dividend has to be paid. Then look at this. In first case, they are expecting an ROE of how much? 20%. 20 lakhs into 20%, we are expecting a profit of how much? 4 lakhs here. 4 lakhs, 4 lakhs, 4 lakhs, irrespective of the financing plan. So no interest on debt. Second case, 1 lakh. Third case, 50,000. EBT, 4 lakhs, 3 lakhs, and 3 lakh 50,000. post-tax profit 2 lakh, 1,50,000 and 1,75,000. So from where we should have to appropriate the dividend amount. Interest on debt is a charge against profit. Payment of preference dividend is an appropriation of profit. This is paid from post-tax profit, that is paid from pre-tax profit. That is the fundamental difference between these. So earnings to equity shareholders, number of shares and EPS is there. Now the issue is, we are not comparing how much EPS that we are getting from the investment. So here we have to calculate the financial break-even point. Financial break-even point means it is the level of EBIT, the minimum level of EBIT that is required in order to meet the fixed financial obligations like interest on debt and dividend on preference shares. See, when you are getting a profit of 4 lakhs, you are getting an EPS, positive EPS. See, suppose in plan A, we don't need to calculate the financial break-even point since we don't have any fixed financial obligations. But when you are funding from plan B or plan C, we have fixed financial obligations like interest and dividend on preference shares. In this case, we have an obligation of how much? 1 lakh. Suppose instead of getting 4 lakhs profit, you got 1 lakh profit from this project. Then what happened? So this profit becomes 0. Automatically, the EPS of the company becomes what? 0. So this level of EBIT is called as financial break-even point. So if you want to finance the project from plan B, first you have to ensure whether you are getting a minimum profit of 1 lakh from this project or not. If 1 lakh profit, if you are unable to get 1 lakh profit from this project, then the shareholders of the company are severely affected because of your financing decision. Since the company's EPS becomes what? Negative. Similarly, in this case, you are expecting a profit of 4 lakhs, 50,000 and 50,000, both are paid. You left with a profit of 1,25,000. There is an EPS of how much? 12.5. See, 50,000 has to be paid. 50,000 has to be paid. The difference here, the dividend on preference shares is paid out of what? Post-tax profit. That means we need more than 50,000 in order to make dividend payment. So 50,000 post-tax profit is equal to what? 1 lakh pre-tax profit. In such a case, 1 lakh is required to make post-tax dividend payment, to make dividend out of post-tax profit, plus 50,000 is required to make interest payment. In such a case, we need a minimum profit of what? 1,50,000. Then this becomes what? 1 lakh. EPS becomes what? 0. So there is no financial break-even point for plan A. For plan B, you need a minimum EBIT of 1 lakh in order to justify the shareholders. You need 1,50,000 in plan C if you want to justify the shareholders of the company. So 1 lakh, 1,50,000 in these two cases are called as financial break-even levels. So break-even means it is the minimum level of EBIT that is needed in order to make fixed financial obligations. At financial break-even point, the EPS of the company becomes what? 0. I hope you understood. Then tell me, what is the basic difference between indifference point and financial break-even point? So indifference point, it is the minimum level of EBIT where two financial plans produces the same EPS. To get same EPS, either of the plans how much EBIT we need from the project, that is indicated by indifference point. If you want to meet the fixed financial obligations, how much profit we need, that is indicated by financial break-even point. See, at financial break-even point, EPS becomes 0. At the indifference point, EPS of two plans becomes identical. So that is the basic difference between these two. I hope you understand. Thank you.